Welcome to Let's Talk Investing, a co-production of the Globe and Mail and the Investor Education Fund. I'm Rob Carrick, personal finance columnist at the Globe and Mail, and with me is Don Drummond. Don is chief economist at Toronto Dominion Bank. Don, let's talk about inflation. The Bank of Canada's inflation target is to keep its core rate, that's excluding all the volatile stuff like energy prices that gyrate all over the place, is between 1% and 3%. What's your outlook for inflation over the next, let's say, 1 to 5 years? How high is it going to get?
Well, I'm a believer in the Bank of Canada. I look back historically, they put in an inflation targeting regime in the early 1990s. They've had the 2% target for almost 2 decades right now, and they've very rarely deviated from it, and the deviation has been very short term. And it's interesting that the question that is on the table right now for renewing the inflation targeting regime with the government in 2011 is only whether they should lower it, not whether they should raise it.
Really? Okay, so
I don't see inflation getting above 2% on a sustained basis.
Because there are those who raise the possibility of hyperinflation. There's so much stimulus pumped into the system, they say, that we can't help but see a big price surge as the economy sort of, hits the ground, it gets traction and it really takes off.
So I think this is a great tribute to the late Milton Friedman, because he finally convinced people that rapid growth in money supply creates inflation, but unfortunately people only remembered half of the equation. The money supply actually has to create a hot economy first. It's not the money supply that does it. Yes, the money supply is absolutely ripping in the United States, but there's tons of slack. I mean, in technical terms, the velocity.
So you're saying the economy is just not strong enough to generate hyperinflation then?
I don't care if the money supply doubles tomorrow. If there's slack in the economy and there's a 10% unemployment
Don, what's
rate,
the money supply? I bet some of the viewers are going to be wondering that. Tell me in real simple terms what that means.
Well, how much money is circulated around in the United States economy, because that ultimately is what determines the demand for the goods and services and the inflation. But there is not only the hard physical count of the money, but how often it turns over.
So we have economies that are just not going to be performing at tip-top shape. We're not going to have hyperinflation. It sounds to me like inflation is just not something the average investor and the average homeowner and average consumer needs to worry a heck of a lot about then.
Well, to me, in my investment portfolio, I'd kind of dial that in at 2% and I'd set it aside. And
so in other words, inflation is situation normal then. I mean, we've seen 2% for decades, and we're going to see 2% looking ahead, and that's just, there's a lot of things to worry about financially these days. It sounds like inflation doesn't need to be one of them.
It's one to have in the back of your mind. If you were a government, let's just say if you were President Obama, that you would love to call up the head of the Federal Reserve Board and say, let's just crank up inflation a little bit, because that would be an awful lot easier way to reduce your debt. But I don't think that will happen.
Good. I'm not going to worry about inflation. Thanks, Don.
Okay.